Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining me for another one of these Monday morning market updates coming to you at 9 a.m. Eastern. Monday morning, well, not Monday morning, obviously. Market was closed yesterday, so Tuesday morning this week, but usually Monday morning. Getting you ready for that the stock market this week. All the stock market news, the trends, the strategies that I'm watching, as well as the stocks that are going to highlight the weekend. So love seeing all of you here. Let me know in the comments if or in the chat if I'm coming through loud and clear. I already see a lot of the longtime citizens of the Bowtie Nation there in the chat, and we're going to get started because market closed down for the 10th out of 11 weeks last week. Really an historic downtrend in the markets. Actually closed biggest weekly close since March of 2020. So since the pandemic, down about 5.6% for the S&P 500. What was interesting with that was the S&P 500 actually closed lower than the Nasdaq. So it seems that where the big crash started with those tech stocks, started with the growth stocks, it has now spread to the entire market. All stocks, even the old school industrial stocks, even the telecom stocks, are getting hit with this crash. And as I sit here waiting for Thor: Love and Thunder to come out, it strikes me that, if you're looking for great dramas, great stories, one of the best stories told is in the stock market. I think investors believe that the stock market is rational, that it's facts-based, and that it's always kind of reflecting a fair value for stocks. And it's just not true, right? The stock market is more like a movie that's based on a true story, right? But lots of liberties with the facts and with the actual reality there. So I'm going to show you, how the stock market is lying to you, what the stock market story is right now, and where it's wrong, and how you can use that to invest, right? How you can invest in the stock market crash. Stick around after that, though. We'll also be covering, obviously, each week our stock market trends, the news that I'm watching, what to watch this week, as well as the stocks that could define the week. So stick around for that. If you do, I do want to do a pitch real quick for the Motley Fool. Here we go. I put a link in the chat there. If you want to see the stocks that I'm buying and holding forever, basically my forever stocks, some of the largest positions in my portfolio, click through that link. You'll go to a free report. Just put in your email address. They'll send you the free report by email there. And these are, you can invest short term or you can invest long term. Long term is so much easier. It's so much more stress free because you have the story behind those stocks, those long term growth stocks, and you can invest in those. So click through that link. I'll also leave it in the description. Now, the Motley Fool is going to send you a couple of emails trying to get you to sign up for their Stock Advisor program. I use the news, or I look at the newsletter. I like their analysis. It's not, an obligation though. It's totally free, no obligation email. Just something I put together with the Motley Fool. Help supports the channel, so I appreciate that. So, go ahead and just click through there if you can, or when you have time, and sign up for that. But I want to get started here because we do need to start. We do need to talk about really what the stock market is telling us, right? The prevailing story, right? And we'll call it that. Sometimes you'll hear people say it the stock market narrative, right? But the story is that inflation is out of control. The Fed will have no choice but to raise rates aggressively to bring that down, and it's going to have to do that so much, or raise rates so high that it's going to choke off the economy. We're going to get a recession, and the stocks are going to fall even further. I've heard some, Morgan Stanley, I believe it is, still has its call for 3,400 on the S&P 500, which would be about another 15% down from here. Be about 28% down from the peak of last year. And actually the average, that's about the average of stock market crashes, right? 28% down from the peak is where we see the average in a lot of those. So they're kind of just calling it an average stock market crash at this point. I have seen others, other calls for stocks to fall even much further, all the way down to as low as 2,500, which would be more than 50%, which would be about 50% from the 4,800 high, the peak that we saw late last year in stocks on the S&P 500. But and I do believe that yes, the Fed will have to raise interest rates aggressively. It did so in the last meeting, 75 basis points. It's probably going to have to do 50 basis points at least over the next few meetings. All the Fed members agree and feel that they're going to get to 3.5% even on the interest rate, or on their Fed funds rate, through this year, which would be a huge increase. And it's just hard to see how that doesn't push us into a recession, right? But no, even the most bearish analysts out there, even the ones that are calling for a deeper correction, a deeper crash in stocks, no one is calling for a cyclical or a secular bear market. It's something we talked about in one of the live streams a few weeks ago. Really, that 10 to 15 year period where stocks go nowhere, and it does happen. It happened in the 60s and the 70s. It actually happened in right around 2000, right? There are periods where the stock market just tends to stagnate over long periods of time, 10 to 15 years. And over that period, stocks go nowhere. Now, of course, within that, stocks will go up. You'll have little cyclical elements within that. But that's a secular bear market, right? A secular bear market or a cyclical bear market is just the normal trends that we think about, the normal business cycle trends where you have a recession, stocks fall, you have economic boom, and stocks go back up, right? And reach new highs. Everyone is calling for that, right? There are just too many technological developments right now pushing that overall growth and that secular growth in the economy. There are too many good labor market dynamics, right, that are driving that long-term secular growth in the economy, right? So even though a lot of people are coming over to the side of, yes, we will have a recession, whether it's a short one or a longer one is still up for grabs, but everyone is saying it's just going to be a cyclical recession and not a secular one, right? So you really have to look at what the market story is telling you and where that's wrong, a lot of the growth stocks, so if stock prices and economic growth are likely heading higher into a new bull market within a few years, right? Within at least a couple of years, then that current market story on growth stocks is more of nonfiction, right? I want to show you the valuations here on, let's take a growth stock. Let's just say, I'll switch this over. Let's just say Teladoc, right? Teladoc Health. So let's look at what the market story is telling us about Teladoc. Go here to Morningstar, and we'll go to the valuations tab first. And now, so Teladoc is a company, a lot of these growth stocks, companies that are still growing their sales at 20, 30% a year. Okay, so last year, whereas everybody was paying through the nose for these stocks, the market story was that these were going to change the world, these growth stocks. They were growing their sales 20, 30% a year. These were going to be ginormous companies. And, the market was paying 20 or 30 times on a price to sales basis. We can see that here in the valuations tab on, and I'll enlarge this so you can see it. Okay, so here's the valuations tab for Teladoc. You see price to sales here. You see 2020 was 17.6 times on a price to sales basis, right? Even into 2021, it was even higher. It was, I think this one topped out at about 20 times price to sales basis. So the market story for Teladoc and many of these growth stocks was that kind of growth over the next 10, 15, 20 years was valuable enough that people were paying 20 times the current sales of that company as a stock price, right? Now what do we have? Now what's the market story telling us now? Now, for some reason, even though Teladoc and many of these growth stocks, growth companies are still booking 20, 30% annual sales growth. Okay, Teladoc is expected. Management has put out expectations to grow sales by 20% annually over the next through 2025. So at least over the next 3 years to $4 billion. Right. This is that industry or that niche of virtual healthcare is ginormous. Teladoc has a clear and demonstrable advantage over its competitors over that in scale and scope, right? It rules that virtual healthcare space, and the market potential for that is huge. So there's no doubt that it will continue to grow at that growth stock pace, right? At that 20% plus pace in sales for many years. But now, for some reason, the market story is that future growth is only worth 2.27 times sales. Okay, 2.3 times sales. At one point, just last year, it was trading for 20 times price to sales. Now it's trading for 2.3 times sales. Okay, so where is the disconnect here? The point is how you make money in stocks. Really, the only way you make money in stocks is looking at this market story and really kind of second guessing it. Trying to figure out where the market story is wrong. Was it wrong last year when these stocks were 20 and 30 times on a price to sales basis, when the overall market was 30 times on a price to earnings basis? Of course it was. It was ridiculous. Of course, we knew that inflation was going to be coming up. The Fed was eventually going to have to raise rates and take off some of the trillions of dollars of stimulus it was pushing into the economy. And that was going to lower the valuation on many of these growth stocks and the market in general, right? But that doesn't mean the market story is correct right now either, right? We tend to, the market is controlled by humans. It is a factor of human emotions. And those emotions kind of screw with the story, right? So you really have to look at the story and say, okay, you know what? Yeah, these growth stocks, they're not growth stocks anymore, right? But they're not momentum stocks anymore because they're not going up through the roof every week. They're not worth 20 or 30 times on a price to sales basis, but they are still growth companies. They're still changing the world in which we live, changing those industries. They're still growing their sales at 20 or 30% a year. And there is no way that these are only worth 2 times on a price to sales basis. So, really understanding how the story plays out, or the story the market is telling investors, is how you not only make money investing in those beaten down names when stocks do crash, like right now, but also avoid losing money when, something like last year or the last couple of years when these stocks were valued at such ridiculous levels, right? You always have to second guess. You always have to play devil's advocate to that market story and kind of understand how much of a fiction it is, right? How much of a based on a true story it is, rather than that rational, efficient market that we all think that the market runs by. Okay, there's a lot of people that think the market fully reflects all news and all analysis and the facts all at any one point. And it's just ridiculous. How could it? Okay, how could the market be right 1 year ago when stocks were valued at 30 times on a price to earnings basis, and some of them 20 and 30 times on a price to sales basis? How could it be right then and right now when those same stocks are valued at maybe 2 or 3 times on a price to sales basis, right? Yes, interest rates are going up a little bit. We are seeing a recession, but if it's not going to be a long-term, 10-year recession or a 10-year bear market, then that just means we're going to have a bull market in the next couple of years, right? And these stock valuations are going to go right back up. Okay, so the market can't be right on both counts, and in fact, it wasn't right on either count. Okay, it wasn't right last year, it wasn't right this year. Your job as an investor is to figure out, how wrong is it and in which direction. Okay. Because that's really how you make money in stocks. It's the only way you make money in stocks is figuring out, how the market is wrong, what's that next shoe to drop in the news or in trends or in strategies, and invest for that. So we're going to start on the market update this week. Again, like I said, market's been down 10 out of the 11 weeks. Out of that last 11 weeks, unfortunately, I don't think we're at that level of really panic and capitulation in the market just yet. So, and we do have higher interest rates to watch for. We are starting to see those interest rates start to drag on economic growth. So we are starting to see the economy slow down and probably heading for a recession later, not this year, but early next year. Actually I think I saw Credit Suisse is actually forecasting a recession to start this year in the fourth quarter, so in the last 3 months of the year, and they're actually calling for the recession to last for upwards of 5 or 6 quarters, which would be, a quarter is 3 months, which would be actually about a year and a half, right? So starting the end of this year, going all the way through 2023, and then through the first quarter of 2024, Credit Suisse is calling for that recession to last that long, which would be a huge recession. It would be a very long one, one of the longer ones. And I do think it would very severely test investors, right? Most investors, especially the new ones that have never really lived through a recession anyway, but a lot of the new investors that have only seen a bull market, for the last 12 years, aren't going to be used to it. Even some of the older investors that have lived through maybe that 2008 crash and have invested through that, that was a fairly quick crash for stock prices. Right. So if this one lasts, 6 quarters, it does go on longer, then I think you're going to see prices fall a little bit further than what a lot of people are expecting. Again, I think we've talked about that formal strategy of investing over the last few live streams, over the last few weeks, talking about putting markers on the S&P 500 for when you're going to invest and not getting stressed out watching the market every day, trying to time the market. So I think the next time that I'll probably be investing money is going to be right around 3,400 on the S&P 500. Again, that would be about 28% down from the prior peak last year. And then so probably about 3,400. I'll probably wait and after that until maybe 3,100, and then after that maybe 2,700 or 2,500. I think probably by 2,700 on the S&P 500, maybe 2,600, I'll probably be all in on my cash. If the market keeps on falling after that, then I'll probably maybe even consider a little bit of margin, buying a little bit of margin, because at that point we're about 50% down from the peak, which would be pretty much the bottom, I think, of the bear market. Consumers are still pretty strong, still spending that cash. Labor market employment is still pretty strong, and corporate balance sheets are still pretty strong. So I doubt that it's a very deep recession, even if it's a little bit longer, even if the Fed has to increase interest rates for a little bit longer than expected. And I think that's what Credit Suisse is looking at when they make that call for a longer recession, not necessarily a deep recession, but just a longer one, right? They're saying that because inflation is so high and because unemployment is so low, the Fed really has to raise interest rates and keep them in there for a longer time, for a longer period, to be able to bring inflation down, but not hit the labor market too much, right? And the labor market's going to be fighting them the whole way, right? As long as the unemployment rate is super low, as long as people have jobs, they're going to keep spending, and that's going to keep driving inflation, right? So the Fed has kind of a tricky situation here where they have to raise interest rates enough to bring down inflation, not hit the labor market too bad, but weaken it a little bit, right? And it's just going to take a long time to do that. So I think that's where Credit Suisse is talking about with that longer recession than normal, but not necessarily a really bad recession. Not one where we see unemployment of 10%, right? I think that the highest in unemployment we'll see is probably closer to maybe 5% at the most, 5 or 6%. At that point, the Fed definitely would jump in and say, okay, you know what, we're going to pause this interest rate hikes. We might even pull back a little bit on the interest rates if unemployment does reach 4.5%, 5%. I think that would be kind of their breaking point. So let's look at the what the sectors did last week. And we can go here to the sector tracker. Of course, this is sectorspider.com. Love using this every week. The sector tracker one just shows us what stocks did over the last week, gives us that big picture idea. And of course, all 11 stock sectors closed lower last week yet again. Even some of the safety sectors like consumer staples offering really little relief here. Consumer staples actually did the best among the 11 sectors, and even that was down 4.3%. Utilities were the second worst sector, actually, down 9%. I think a lot of that was kind of falling in sympathy with the sell-off in energy prices. Sell-off in the materials sector was also kind of interesting. Materials stocks in the materials sector fell 8.3%. A lot of your mining stocks and things like that, manufacturing and logistics. All 28 companies in that sector, all 28 companies in the materials sector fell. All of them but one more than 4.6%. So I think one stock in the materials sector only fell maybe less than 0.5%. All the rest were 4.6% or more down. sell-off appears really on the fears of that recession that's just going to lower the demand for more of like a cyclical sector like that. As far as the big news last week, of course, was the 17% plunge in energy stocks, and I think there's an opportunity here, right? An opportunity to kind of diversify, kind of protect your portfolio. I do expect the price of oil to fall further, right? There's just especially if we're expecting a recession, there's no reason why oil would be over $100 a barrel. There's just not the demand there. We are starting to see some demand destruction from those high gasoline prices and things like that. But obviously, as long as the Ukraine conflict is, as long as we don't have a resolution for that, oil is going to be higher. Right, so oil will probably stay above $100 a barrel until Russia and Ukraine come to some kind of resolution. And that means exposure to oil stocks, could kind of help balance the risks in your portfolio. Okay, so I do see, especially after some kind of resolution, oil prices will probably come down to $70, $80 a barrel, and that's going to bring these oil stocks lower. But what we see here, if you think about this, what the factors that are driving oil prices and really driving these energy stocks are different from the rest of the market, right? So if you think about this, if the Ukraine conflict does continue, that price of oil is going to stay higher, and energy stocks are just going to be cash flow machines. Okay, most of these stocks, I'm thinking shares of Chevron, even Exxon, Mobil, which has a cost of production of somewhere around $50 or $60 a barrel. But Chevron, RDS, some of these other energy companies that have costs of production right around $30, $35, $40 a barrel even. I mean, they are just cash flow machines with oil prices at $100 a barrel. Okay, they are making cash money hand over fist, and they're returning it to shareholders through share buybacks, through dividends, things like that. So if the Ukraine conflict does continue, that price of oil is going to stay high, no matter what happens to the economy. And those energy stocks are going to do well. Now, if the conflict is resolved, then yes, energy stocks are going to come down. But if you've got the kind of an energy stock and other stocks portfolio, if those energy stocks do come down and oil prices come down, I think the rest of the market can rally on that, right? Obviously, inflation has been the big driver, the key driver in the stock market crash and the sell-off. So if it looks like that might come down because oil prices are coming down, energy costs are coming down, then the rest of the market could rally. So I think you still do want some exposure to energy stocks here, just on that balancing effect, right? If you have energy stocks in your portfolio, then those are going to do well for as long as the Ukraine conflict lasts. If the Ukraine conflict comes off, then yes, your energy stocks are going to take a hit, but the rest of your portfolio is going to come back up and make up for it. And I do believe, even like I said, even after the conflict resolves itself and oil prices come down, a lot of these companies are still cash flow machines, right? Even in a recession, even without the conflict, oil prices are going to be in the 60s and 70s, bare minimum. And and that's still going to be profitable for a lot of these companies. So they are still going to be good cash flow companies. I want to look at kind of what we're looking at, what we're watching for the week. It's a holiday shortened week. There's not a lot of economic news. Chair Powell of the Fed does testify before Congress this week, likely just going to be reiterating the same message he gave last week, with the Fed is singularly focused on fighting inflation and ready to be as aggressive as it needs to be. Obviously, some of the Congress members are going to grill him on whether they're ready to slow down the economy so much and push us into a recession just to get inflation down. And I think he's going to have to be pretty hawkish on that. The Fed, a lot of economists out there are still kind of delusional that we can avoid a recession. It's not happening. Every week you see more and more economists, more and more of these analysts and banks come out and say, okay, yes, we probably will have a recession. At this point, they're still kind of hedging it. They're still kind of saying, oh, but it'll be a very light recession, barely even noticeable. Don't worry about it. And that's what you see. Every cycle you just see that. You start seeing people saying, oh no, we're not going to get a recession. It'll be a soft landing. We'll be fine. Then they adjust their bets a little bit. We might get a recession. We might not, but it'll be a year or two down the road, because who the hell remembers what they said a year or two down the road? Then they shift, of course, then they start shifting to actually calling, yes, we will get a recession. It's going to happen pretty soon, but it'll be a light one, and then so on and so forth until, they're finally coming up to the facts of what the recession is going to be. The Fed itself has lowered its 2023 guidance down to 1.7% economic growth, right, for the entire year. I've actually seen some that are saying that the entire 2023 economic growth is going to be negative, so that would be a recession, the next year. And that just leaves no room for error, right? No margin for error. Any kind of other shock to the economy or anything like that will definitely easily set us into a recession, and I think it's going to happen. Something else to watch for this week: earnings from home builder Lennar come out. I believe Tuesday. As well as the existing home sales report, which is going to be, I think, Wednesday. Mortgage applications, sales activity has really fallen through the floor on housing. So it'll be really interesting to see what Lennar says, as well as that existing home sales report says about the state of the housing market, because of course, housing has been extremely strong over the past couple of years, really kind of in bubble territory. As those interest rates increase, I've seen something like estimates of a quarter of all 25% or more of all home buyers are now priced out of the market, that they just can't afford the prices that houses have gotten to, as well as the interest rates. Interest rates have increased from about 3% on that 30-year mortgage at the beginning of the year to 6% right now, and have added about $1,000 or more onto the average home selling price. I do believe, a lot of analysts and economists are still saying that housing prices won't fall. I actually think they will fall a little bit over the next year. I actually think we will see maybe a 5%, 10% drop, probably not 10%, maybe 5% drop in the average home selling price, just because, as those interest rates creep higher, there's no way people can afford houses anyway. On Friday, the Michigan Consumer Sentiment Index is out. I usually don't put much faith in this. I think consumers tend to say one thing and then actually do another. So I don't usually watch the Consumer Sentiment Index. Since there is almost no other economic data released this week and really nothing happening, I think it'll be maybe a little bit more important than it usually is. I think it's going to show a big drop in consumer sentiment, and that could shake the market. Right? Consumer spending is 70% of the market. If as consumer spending falls, you really start to see those calls for a recession and the reality of a recession. So if consumer sentiment does fall again this month, which I think it will, then I think you're going to start seeing more economists calling for a recession and probably kind of hit the market a little bit. I want to look at some of the stocks I'm watching this week. Lennar is the first one. Again, it reports earnings today. Let's just update this. I think we are looking at a higher open for the market. Market is opening 1.6% higher on the futures. We'll go back here to Lennar. So Lennar Corporation reports earnings today. It does look higher in the pre-market here, ticker LEN. Now, the benchmark for home builders, so all the home builder stocks, is now down 42% for the year, right? Really matching losses on Lennar, which is also down 42%. It's the second largest home builder in the country. Last week's new home sales showed single-family sales falling to lows not seen since June 2020. So home sales are falling. Sales backlog projections are likely to disappoint when Lennar reports, right? It's just those higher interest rates, right? They're just shutting out so many buyers, and I do expect Lennar to put out some pretty weak numbers or pretty weak projections anyway for the rest of the year, which would make me wonder about the stock and the state of the housing market there. FedEx reports on Thursday. Had a huge week last week. FedEx is expected to report $6.88 a share, a jump of 37% last year. So, right, on sales growth of 8.4%. So it's really interesting how FedEx has been able to grow so much. We are not seeing very many companies left that are pushing 37% earnings growth in a year and 8.5% sales growth. Okay, most stocks, their earnings and sales have come down quite a bit from last year. And it's also interesting how FedEx is expected to turn that 11% sales growth this year, the 8.5% for the quarter, 11% sales growth expected this year into 13% earnings growth, right? Most of the market story right now for most other stocks has been that, yes, sales growth is still there, sales growth between 3 to 5% for a lot of companies, but the earnings are getting hit from that inflation. Companies are just not able to pass on those costs that they're getting, those higher costs from inflation. They're not able to pass those on to customers. So they're having to eat some of those costs. Their wage costs are going up, obviously. So we're seeing higher sales growth, but lower earnings. All right. So a lot of these companies posting, maybe 5, even 10% sales growth, but only 3 or 4 or 5% earnings growth. Right. FedEx is different here. For some reason, FedEx is saying, or analysts are still expecting FedEx to post that 11% sales growth and higher 13% earnings growth. Shares did surge 14% last week on a dividend hike, as well as they named 3 new directors to the board of directors in an answer to an activist investor pressure. I like FedEx, especially kind of long-term profitability through self-driving and electric vehicles, right? I think we're on the cusp of really that technology for commercial trucks being electric as well as self-driving. And I think that's really going to drive profitability for a lot of these transportation stocks, right? Trucking stocks, FedEx, things like that. But I'm kind of a little worried here. Shares are topped out on a short-term basis on FedEx, especially with that 14% jump last week. The potential for bad news this week when it reports earnings and says, you know what, inflation is hitting us too. We might see good sales growth, but we're not going to see earnings growth quite as much as is expected in the market. So I would expect, some warning on especially higher fuel costs, other costs during the earnings report here for FedEx. Darden Restaurants, Olive Garden. Think Olive Garden. Think those other fast, those casual dining restaurants, I guess they're called. Darden Restaurants, ticker DRI, also reports on Thursday. It's going to be an important read on not only cost pressures in the restaurant industry, right? So how much is inflation, food costs? How much is employee wages, wage pressures affecting just the restaurant industry in general? But really just a general read on consumer spending. Okay, this is where people go out to spend their money. On their nights. Competitors Brink International, which is ticker EAT, and then the Cheesecake Factory. They both missed their earnings expectations, even while meeting or beating sales estimates. So again, this is what I'm talking about with most of the stocks in the market right now. They are actually posting sales that are pretty decent. Sales growth that is okay. They're meeting or beating those sales estimates, but they're missing those earnings expectations because of those costs, because of inflation, and because of those other cost pressures, really driving that profitability lower. Any drop in consumer spending and the mood is likely to be difficult for these fast food or these restaurant companies, right? When you see your wages, if we do see a recession, we start seeing people laid off, we start worrying about our paychecks. The first place we're going to not go probably is that extra time out to eat at Chili's or the Cheesecake Factory or Olive Garden each week, right? So it probably will hit these companies eventually. I would expect Darden to kind of warn on those higher costs this week when it reports earnings. Next one here, CarMax, ticker KMX. CarMax wraps up the week with its earnings report on Friday. Shares are down 31% this year and 44% from last week's peak, right? Or last year's peak. This was one of the companies, these car companies that really saw their shares surge there during the pandemic when used cars were really at a premium. Companies expected to report sales growth of 4.9% this year to $33.5 billion, but a decrease of 16% in earnings, right, to $5.88 a share. So again, really showing that trend. Strong, fairly strong sales growth, but just a plunge in earnings on that lower profitability. Last 2 years now with CarMax, it's interesting. Last 2 years have really seen management sacrifice that profitability in favor of sales growth and really the market share. So what management has been doing, they've been spending more towards marketing, spending more towards, really getting the message out there, driving that sales growth, that higher sales growth. And obviously that comes with a cost, right? Those higher marketing expenses, higher employment, higher wages, things like that really come at a cost to drive up sales growth and steal market share from its competitors. It comes at a cost of lower profitability and lower earnings. Now, that said, I do think there could be a shift here. The focus on cost cuts. So If management comes back and says, okay, you know what, we're looking at kind of a weaker economic outlook. We don't want to be pushing quite so hard to drive sales. We want to become more profitable. We want to, kind of right size the labor force, right? That's what they usually call it, which just means layoffs. We want to cut down on some of our marketing expenses. If customers aren't going to be in the market for a used car or a car anyway because they don't have jobs, or if we have a recession, there's no sense spending a ton of money on marketing. So I think they do come out, this Friday in their earnings report, say we're gonna pull back. We're gonna focus on profitability for at least another year, at least a year here. That could cheer investors, right, on the prospect of that stronger earnings and really raise the stock from what's a 10-year low in its valuation. Shares of CarMax are now trading for just 0.43 times on a price to sales basis. So, not necessarily saying that the environment for car dealers or CarMax is going to turn around or is going to be that much more positive, but I do think they will come out and say, you know what, we're going to focus on profitability here. We're going to, maybe even raise our projections for earnings, and that could cheer investors there. So now I want to turn it over to question and answer here. Obviously, one of my favorite points of the live stream, just to get a closer face-to-face connection with y'all and answer some questions. So I'm going to scroll up here and see what we have as far as questions. I see a lot of old citizens in the Bowtie Nation there, the Quags. Good morning to you. Ivan Van Order wants to know about AG&C. So, AG&C mortgage REIT, these mortgage REITs, they tend to do very poorly against inflation. Inflation drives up interest rates, and they really have a lot of interest rate sensitivity in these mortgage REITs, right? They're borrowing short term and then lending out or buying those long-term mortgages, right? Those mortgages at those long-term rates. Well, the problem with that is, especially as we head into a recession, then the yield curve tends to flatten. Okay, so here's the short-term rates, those 2-month, 2-year rates on interest rates. Here's the longer-term rates, which normally in a just decent economy, you would expect lower short-term rates and longer long-term rates, right? Investors, if they're going to be locking up their money for 10 or 20 or 30 years, they're going to want a higher interest rate. But as we head into a recession and with a poor economy, then we see that flatten out, a flattened yield curve, right? So what's happening with these mortgage REITs is they're borrowing at the short term. So they're borrowing that money at the short term, buying mortgage rates at this long term, and they're pretty much getting the same rates, right? They're not getting that difference in the yield, which is their normal business model. So that's really why mortgage REITs are getting hit so badly. Obviously, with interest rates rising so high, then there's really a big drop in demand for new mortgages. So that obviously hits their supply of investments that they can invest in. So it's gonna be tough for the mortgage REITs for at least probably another year. Okay, it's gonna be tough for these mortgage REITs. The thing you need to consider is, if you are going to invest in these, then invest in the larger ones, the ones with that financial health and the flexibility to survive. We will always need mortgage REITs. We will always have those companies that are buying those mortgages and really helping to support the mortgage market, the supply and demand of mortgages in that market. So AG&C is a good stock, good company. It's going to be tough over the next year, just a tough environment for those mortgage REITs. But AG&C is one it's going to survive and it's going to pull through, and it's still going to provide pretty good dividend yields. I wouldn't expect the dividend yield to stay where it is right now. As far as maybe the percentage yield could be okay, but that dividend is going to get cut as the stock price goes down. So expect that, really expect the worst, and you could be surprised on the upside. Again, I do like the stock going long term, but it's going to be tough here. What else? Doug, good to see you. Doug Holes, Gonzalo, good to see you there, man. Gail. What else do we have? Your videos, of course. Kelloggs splitting into 4 different companies. That's interesting. So Joseph says Kelloggs is splitting up into 4 different countries. I'll have to see that. I'll have to look for the news on that because I haven't seen that yet. be kind of interesting. We are starting to see, some companies reevaluate those huge conglomerate ideas, right? We saw it with, AT&T spun off a lot of its stuff. General Electric is talking about splitting up its divisions, or splitting off some of its divisions. Evidently, Kellogg's is doing that here. And a lot of times you start to see kind of cycles of that, right? I've been investing since 1999. I've seen a couple of these cycles where it's vogue for management to just gobble up everything they can, buy up other companies, and really become just this mega massive company with different divisions and segments. And then other times where it's a little bit more popular to split up and focus on one particular thing. So that'll be interesting to see what Kellogg's does. Gold stocks seem to be good value now, Jay says. I'm not a huge believer in, not at all in gold. Gold stocks are a little bit better. I think they probably come down pretty recently just on the drop in gold prices. Again, I think the price of gold is going to be extremely range bound. Okay, the thing you got to understand about the price of gold is that, yes, it is kind of an inflation hedge, but the bigger factor here for gold is interest rates. Okay, gold, if you're holding gold, you get no cash flow. You get no return on gold until you sell it. You sell it at a higher price, right? So that means it yields nothing while you hold it. That means that these interest rates and other yielding investments like bonds, dividend stocks, anything that yields a dividend yield or kind of an interest rate or a coupon or anything like that, that is going to be a competitor for gold, right? So as interest rates go up, gold investors are sitting there saying, you know what? I mean, I can, a year ago, I wasn't getting anything on bond yields, things like that. Now I can get 3, 4, 5% on a bond yield. And as long as I hold it to maturity, then I'll get that yield. With gold, I'm not getting anything, right? So that tends to depress the price of gold as interest rates go up. Also, the strength of the dollar as the Fed is increasing interest rates, as inflation starts to come down, that's really going to be supporting the value of the dollar, which of course that brings the price of gold down as well. So yes, gold is an inflation hedge. It is a safety bet, but it also has a lot of other factors that are going to be limiting the price appreciation. So, I really do see gold range bound, probably within that $1,750 to $1,900 range for probably the foreseeable future. Now, what that means for gold stocks, obviously, a lot of these gold miners, they have cost of production right around $1,100. I think the all-in sustaining cost for the entire gold mining industry is right around $1,200 an ounce. So obviously that still leaves a lot of room for profit. Even $1,700 per ounce on gold would be $500 of profit, per ounce for these gold miners. So they still are, cash flow machines. They can still support those dividends and even some growth. So, I do like the gold miners better than gold itself because, you get that dividend yield, you get that upside appreciation, that kind of thing. But, as long as gold is range bound, you're going to see those gold miners range bound as well. So just understand the dynamics in the gold pricing. Billy Marion, Raw Devil Dog. Says he bought Pfizer and Southern Company in the pre-market. What do you think? I mean, both solid companies. Pfizer, Pfizer is one of those stocks. We actually did a video a few weeks ago on the stocks that tend to hold up in the recession. We looked at research from the 2007-2008 crash and looked at the stocks and the industries that held up in there that sold off less than the rest of the market. And of course, drug stocks was one of those groups. Obviously people need their heart medication, whether the market is up or down, whether we have a recession or not. So drug stocks tend to be good. Pfizer, obviously one of the best in the group, has a great pipeline, even beyond those COVID vaccines. Pfizer has a pipeline that's going to support its sales growth and earnings for forever, basically. So Pfizer is a good stock. Haven't watched it in a while. I actually owned Pfizer, for a couple years there, especially during the crisis, the pandemic, sold it off, really as it was reaching those peaks with the vaccine, because it does have a lot of sales to make up, right? It had huge sales boost. I think it was booking something like $10 billion last year on the vaccine alone. And obviously that's going to come off in the next few years. So it does have to kind of justify where the price is, as well as where that sales growth is going to be. But it's a good long-term stock. What else? Do you have any thoughts on Okay, EDR haven't followed them, so I really can't tell you one way or the other on that. Kept up money average down 9. Should I keep going? Okay, so Roman wants to know. Great question here. I've kept putting money into Rocket, so ticker RKT. It's Rocket Mortgages. To get my average down to $9. Should I keep buying more and get it down more, or should I just get a rock and put it in my pocket and use it? Okay, so Rocket Mortgages, right? Obviously, probably selling off pretty heavily. One, because mortgage demand is falling off a cliff, and it probably will continue to fall. On those higher interest rates. So mortgages aren't looking good. Rocket Mortgages also, one of these stocks that just recently came to market, IPO, or might have been a SPAC last year. So very high valuations on that. It's kind of a bad situation. Now this is another one of those where it's a good company. It's still a strong fintech company. I do believe it'll be around for many years, and they'll do well because they are very well positioned in that fintech space. And I think mortgages is just the start for the company, but it is going to be tough. And with averaging down, the one thing I want to say about averaging down is that you can follow a stock all the way down and it can become 10 or 20 or 30% of your portfolio, and that's just the wrong way to go, because bad things happen even to good companies, right? So say Rocket Mortgages, say management does something shady to kind of improve the numbers. Say even something happens to the mortgage market, housing falls more than we expect, something like that, and destroys this company. You do not want 20 or 30% of your portfolio in that one company. Okay, so yes, you can average down a little bit. I wouldn't average once you hit 5-7% of your money in one stock, in one company. Once you hit 5 or 7% of your money in that company, 10% at the most, then that's it. It's got to stop. It's just got to stop there. Even if the stock falls further and you want to lower your average cost, you just can't do it, man. Because eventually it is just too easy to follow that stock all the way down, make it your entire portfolio, and then what happens? What happens when it just fails? It goes bankrupt, and the investors are wiped out. You just can't risk that kind of loss on your portfolio. So follow it down a little bit, average down. That's fine if you really believe in the company. I think it's a good fintech company. It'll be better longer term returns once the mortgage market rebounds over the next cycle. But there has to be a limit to it, man. Okay, what else? Square has been rocked. Steve in Austin says Square has been rocked. It has, all of these, basically every company. And this is something we talked about in that market story idea, is that even good companies are selling off in this, right? Even those companies that are changing our world over the next 10, 15 years, even those companies that still are quality growth stocks, still doing earnings, sales growth, posting positive earnings. Even those companies, even the consumer staples companies, right, that are extremely safe cash flow, those are still being hit. Okay, so don't think that in this market that just because a stock is falling that it's not a good company, that it's not a good investment. Okay, because everything is falling. Investors are just selling out of everything, throwing the baby out with the bathwater, so to speak. And there's becoming some real opportunities, here over the next few months. Square has kind of a double, a double whammy here, because it is so involved in the blockchain and in Bitcoin. Obviously, ticker SQ, they changed its name to Block because it is now obviously a blockchain company, I guess. So it has been hit in the in the sell-off in Bitcoin as well. I do like the company. I prefer PayPal a little bit better, just because it's not quite as focused on Bitcoin and the blockchain. I think PayPal, you get that fintech space, you get the payment space, you get a little bit of cryptocurrency space in that. So it's a little bit more diversified on its side. It's got great digital wallet exposure for PayPal. So I like PayPal a little bit better than Square. Square is a good company though, and will be around. Okay, what else? Thoughts on price to sales relevant to anything? Okay, Alex wants to know why the price to sales is relevant to anything. I mean, it's how are you going to value a stock? Okay, there's a few ways you value a stock on that price multiple, right? Okay, so you can use like maybe a discounted cash flow. You can use a yield measure to value a stock. But if you're going to use price multiples, so price to earnings, price to sales, price to cash flow for a stock, then I prefer the price to sales, right? Because there are so many shenanigans management can play in that income statement. Once you get down to, yes, sales can be manipulated a little bit. Okay, if you haven't actually looked at financial analysis and how to analyze an income statement and really pick out, some of the shenanigans that management plays, you really need to look into that. Because with sales, management can give more credit to buyers, right? So they boost their sales a little bit. Of course, they're not likely to collect on all those credit sales, but it's just a short-term way to boost their sales. So sales can be manipulated as well. But as you move down that income statement, there are so many ways to boost their earnings, right? They lower their collectibles, their receivables, or they lower the percentage of bad receivables they think they're going to collect, right? They change their inventory guidance, right? There are just so many ways that management can fudge the numbers on earnings, that if you're using a price to earnings measure for valuation, it's just you just never know, right? You never know how realistic those earnings are. Sales at least are quite a bit more realistic. You can actually see how much sales growth the company is doing. So that's why I use price to sales instead of price to earnings. Price to cash flow is okay too. A lot of investors don't really understand cash flow though, so it's not quite as well used. But so if you're using a price multiple, I would use price to sales or price to cash flow. Okay, it's just much less manipulation in those numbers than compared to like a price to earnings ratio, which would be with earnings. What else? Should do point out. James wants to point out that PEs vary by different industries. Yeah, price to sales, price to earnings vary. Okay. And basically it's just because, okay, so a price to sales or a price to earnings ratio, how much are you willing to pay for that company in that industry for that level of earnings or for that level of sales? Well, what does it depend on? It depends on how much that industry or that stock, that company is growing its earnings or sales, right? I would much rather, if a company is growing its earnings by 20, 30, if it's growing its sales by 20 or 30% a year or whatever, then I'm going to be willing to pay a much higher price for those earnings, for those sales, than for maybe a utility company that's only growing its earnings by 3 or 5% per year. Okay, so really the price to earnings or the price to sales ratio is based on these other factors within a company, within an industry. Okay, so obviously, different industries going to have different rates of sales growth, rates of earnings growth. Consumer staples, those food packaging companies, utilities, electricity generators, things like that are going to have much slower sales growth, much slower earnings growth. So you're not going to be paying quite as much for them. Okay, so some of these other industries with faster sales growth, faster earnings, you're going to be willing to pay a higher, higher price to earnings or a higher price to sales for those. So you don't want to compare the price to earnings for one company against price to earnings or price to sales for another company in a totally different industry and use that to say, okay, this one's cheaper than this one. Well, you know what? This industry might be cheaper than this entire industry anyway. Okay, so you really do, when you're comparing stocks, you need to compare the price valuation, the price multiples in one company against its peers, against the other companies in that same industry, which is the best value company in that industry, not necessarily against all other industries. So what else? I want to see, can anyone see this, or am I shadow banned? So Melvin Master wants to know if he's shadow banned. I don't know why that would be, but nope, your posts are coming through. Let's see, thanks. Anyone Backseat is another nice. I want to thank you for due. I bought 12 stocks for weekly dividends. Haven't seen the weekly dividends yet, but once 2 weeks is still awesome. So Adam says he bought. So I did a video a few weeks ago. 12 dividend stocks for weekly dividends. So basically strategically buying dividend stocks to where they are posting their dividends every week, right? So every dividend stock or those quarterly dividend stocks post their dividends every quarter, right? Every 3 months. They do it on pretty consistent basis. So you can kind of pick the right stocks to get dividends almost every week. Every week, every 2 weeks. Obviously, there is going to be some changes. It's just a matter of when the board of directors declares and pays that dividend. But generally, it's very stable every single week. Now, if you're just starting that, obviously, you have to wait. You have to wait for the next time that company declares a dividend. Okay, so if you're just starting, it could be 2 or 3 weeks before they declare and pay a dividend, and then obviously, even after a company pays a dividend, it's still usually a week before that dividend actually hits your investing account. Okay, before you are actually credited in your account for those dividends, that were paid. So you kind of gotta wait on some of those strategies, those weekly or monthly or biweekly dividend strategies that we talk about. Just watch when those dividends are declared and the consistency and the stability in those. What else? So Jay thinks the Fed will turn dovish prior to the midterms. No, not a chance. The Federal Reserve, the central bank, needs to maintain its independence. Okay. The worst thing that can happen to a central bank or to the Federal Reserve is to appear that it's changing its guidance, changing its actions, depending on the whim of whoever's in power, whoever controls the White House or Congress or whatever. Worst thing that could happen, because obviously then if investors don't believe that the Fed is going to do what's right to bring inflation down or to preserve the jobs market or whatever, then they lose all credibility. Okay, and they can't do their job. If investors and if the public doesn't believe that the Fed is going to do what it's supposed to do, right? Keep inflation down, protect the jobs market, then that just messes with the expectations. That means, okay, if they're going to sell out to the administration or to politics, then we're going to have inflation forever. Okay, inflation is going to go sky high, and we're never going to beat it. Okay, and which those expectations would then obviously feed into even higher inflation. So yeah, the worst thing you could do as a central bank, and this is what we see in a lot of the emerging market countries, especially Brazil. Turkey is another big one where the central bank is basically controlled by the government, controlled by the president and some of these others in the administration, and they've lost all credibility. Okay, inflation is something like 70% in Turkey because despite high inflation and all that, the president won't allow the central bank to raise rates to fight that inflation and to fight the weakening lira. Right. So it's happening in Brazil as well. The worst thing that can happen to a central bank. So no, I don't think the Fed is going to change its tune before midterms or even any time for that matter. Dividends are paid. Use fidelity. Yes. Same stock or move. Okay, so Tim wants to know, should I reinvest my dividend payments into the same stock or move to cash and wait for other buy-in opportunities? Great question here. A couple questions. I actually, should you, when your dividends come in, should you reinvest it into the same stock or other dividend stocks, or should you just be holding cash right now, right? And I can tell you what I'm doing. Obviously, okay. So whether you're reinvesting in the same stock or another dividend stock, I mean, it's basically where you want your exposure, right? If you're building up too much money in that one dividend stock, and maybe you want to diversify into some of your other dividend stocks, then that would be an option. I think a great strategy would be to take some of these high yield dividend stocks that maybe pay out a lot of cash, but the price doesn't go very high. The price doesn't increase very much, so you don't get that capital appreciation. A great strategy might be to take those dividends and reinvest those in some of the stocks that maybe pay a little bit lower yield, but grow their stock prices more, right? And have a history of growing their dividend more, right? So kind of shifting your money from the high dividend yields into the higher growth stocks, things like that, or the value stocks that are selling off. The other idea with should you just put it in cash and hold in cash, I'm holding a lot of cash right now. I'm holding upwards of, by the end of the year, I'll be about 20-25% cash from my wealth. And it's just because, I do think we do see lower prices, lower stock prices. I am waiting for, like I said, waiting for about 3,400 on the S&P 500, maybe a little bit higher, to start reinvesting some of that cash. But even then, it's only going to be maybe a third of the cash that I'll invest. I'm still going to be waiting for maybe 3150 on the S&P 500 to invest more, and then even down into 2800 to reinvest to invest the rest. It depends on how much cash you have, how much cash and those other safe assets you have. If you are all in 100% in stocks right now, you need some cash. You need some cash. You need some safety investments, things like that. So if you don't have any I bonds, I would take that dividend and invest it in I bonds. Right? I would take that dividend and maybe just even hold it in cash right now. Okay, you need some cash just in case this market sell-off does get worse, and you want to take advantage of those lower prices. So definitely something to think about. On the other hand, if you are sitting at a lot of cash right now, then if you're sitting at more than 30% of cash or cash investments, cash-like investments, then I think you reinvest it. I think I don't think anybody needs more than 30% of their money in cash or some of those safe assets. What we have seen in the past, investors that have invested when the market was 20% down, which the S&P 500 is about 23% down from its peak right now. Investors that have waited and have invested at 20% down have averaged 70% return over the next 5 years, right? So about an 11% annual return over the next 5 years on average for people that have waited, at that point where the market was down 20%. So even if the market does fall further, I think you're getting some good deals here. So if you are already sitting on a lot of cash, then I think you can reinvest that money. Okay. Okay. Great video a while back. Okay, so yeah, Marty's talking about closed-end funds. I don't like most closed-end funds, man. They are just so expensive. I mean, whereas you see most exchange-traded funds charge maybe 0.2% on an expense ratio, right? A management expense ratio, charge you 0.5% every year on holding that fund. A lot of those closed-end funds charge upwards of 2% and more as that expense ratio. They are highly leveraged, which means they tend to do pretty well in a bull market, but they tend to fall even more in a bear market and a lot of times cut those dividends. So, dividend yield of 15, 20%, not sustainable at all. Okay. What else? Auto manufacturers still okay to buy long term? So Brian asks, are auto manufacturers still okay to buy long term? Now, not sure where you're getting at this from. I haven't been a big fan of the auto manufacturers. I mean, obviously they had a good run there for a little bit with electric vehicles, but it's a fairly slow growth industry. I think electric vehicles sales are probably going to disappoint, and that's probably kind of a contrarian call. I think most analysts are calling for a huge explosion in electric vehicle sales, and that over the next few years they'll do okay. But I think you're going to see a real backlog or a real problem with electric vehicle production and some of these base metals, not only the battery metals, but a lot of the other metals like copper that goes into these cars. There's actually like 3 times more copper in an electric vehicle than there is in a traditional car, right? So you're going to see some real cost pressures on these electric vehicle production numbers, as well as just consumer demand and that kind of thing. I think as the costs go up for these to produce these cars, the prices are going to go up, and you're going to get some pushback from consumers. A lot of the auto manufacturers, especially the even the legacy ones, have the prices have come up or did come up so much that the valuations were looking a little iffy. They've started to come down recently, but I'm still not really sold on the the automakers as an investment. What else? Thanks for sharing your views. Gold stocks, Teslas. Stocks. So Jay wants to know, are Chinese stocks uninvestable? That is a great question. I actually think Chinese stocks could do well. There's and I pointed this out I think it was last week in our Monday market video last week, that Chinese stocks are probably going to be another good diversifier for your portfolio. Okay, and why I say that is because so while the rest of the world, the U.S., Europe, even some of the emerging markets are in that cutting phase, right? That recessionary cycle, right? Where the central banks are raising interest rates, pushing everyone into a recession, that kind of thing. China kind of experienced that last year, over the last couple of years. Okay, China had a really bad property and housing problem. Their economy started falling. They were already raising interest rates, things like that. So where China is right now, they are now stimulating the economy. They're trying to grow the economy. They've actually got an election this year, so government wants to look good for that, even though they're not necessarily elected. They still want to look good, right? So China, the central bank, is cutting rates. It's pushing money out in the economy. The government is spending, stimulus money, things like that. So China is actually growing its economy while the rest of the world is slowing down theirs, right? So what you see, we're also getting news and rumors and confirmations and things like that the crackdown on China stocks, the regulatory crackdown on a lot of these tech stocks, a lot of that is still starting to come off the table, right? A lot of these stocks, Baidu, Alibaba, things like that, were really hit, over the last year, and obviously, that's affected the economy, right? So the Chinese government is starting to pull back on that regulatory pressure, and that's lifting a lot of these Chinese stocks. So what I think is, I still wouldn't be all in on a lot of Chinese stocks, right? You still do have that listing pressure, between listing on the U.S. or listing in Hong Kong, things like that. So you still do have some risks there, but I do think Chinese stocks will probably outperform U.S. stocks over at least through this year and maybe into next year. So I do think again, it's an opportunity to kind of diversify your portfolio if Chinese stocks do a little bit better. So now that said, I don't own a lot of Chinese stocks right now. I actually sold off my DD when it spiked a few weeks ago. I do own Alibaba though. I got a cost basis about $83 a share on Alibaba. I think I would cover it right around $160. I think it's right around $110, somewhere around there right now. So I still do like Alibaba. I think it's a good valuation and a little bit more upside than a lot of the other stocks. What else has affected coal prices? Market is up and looking good. Joseph Flores says the market is up and looking good. Is this a dead cat bounce? I think it's a bear market rally, which maybe a little bit different from a dead cat bounce. Dead cat bounce is basically just when a stock falls so much in a given day or even over a period, then it just bounces back up because everyone's been shaken out, right? All the sellers have been shaken out and there's only buyers left, very short term kind of thing. Bear market rally, a little bit different. Bear market rally is when stocks or the market has been sold off so much it is oversold on a technical basis. And then that creates buying opportunities. Obviously, valuations are very much lower in a bear market. So it creates opportunities. Investors jump in, it drives the market up. What we're up maybe a percent or two today, drives the market up. People see that, they start thinking, okay, hey, maybe the bear market is over. We're going to start the new bull market, and I got to get in before the getting gets good. So that drives prices up more. And what you see is, maybe a 10 or a 15% increase in the market over a period of, a few weeks, maybe even a couple of months. But the fundamentals haven't changed. And this is a video we did, I believe, last week. So watch that video because it's very important because these things are so dangerous. But the video last week really detailed how long bear markets last, how long what happens in these bear market rallies, what causes them to reverse, things like that. And what we see so often is with these bear market rallies is that, a lot of people get optimistic, but the fundamentals really haven't changed. The things that were driving that market lower haven't changed. Okay, we're still seeing the Fed increase rates, very aggressively. We are still seeing, the economic projections come down. We're still starting to see earnings growth projections come down. We're still seeing all those factors that were driving stocks down. We're still seeing those, and they're still building momentum. right? So nothing has changed to allow the market into a new bull market, right? So inevitably, what happens with these bear market rallies is, yeah, they can go up, 10, even 15%. The one we saw in March was up like 16%, right, on the Nasdaq, I believe. I think 10% up on the S&P 500. But what happens is we get some kind of data point, some kind of, whether it's a CPI report for inflation, whether it's a jobs report, or a central bank meeting, we get some kind of a data report that says, hey, you know what, clue in, folks, because the economy hasn't turned around. Nothing has changed from when stocks were falling. That scares investors once again, and they sell out, right? And we reach those lower lows. I think that's what we're seeing. I think that's what we'll continue to see, throughout this year at least. That we'll see those series of bear market rallies. Now that is an opportunity, though. It is an opportunity that if you have no cash in your account, if you are not ready to buy at those lower prices, then that gives you an opportunity to, when the market does rally 10% or something, then you can go into your portfolio and say, you know what? I like this stock short term. I'm really not in love with this company. I don't know what it's doing. I'm kind of uncertain about this stock. I'm going to take my money off of this one. Okay, the market is giving you a gift by going up that bear market rally, that 10% or whatever. It's giving you a gift, the opportunity to reevaluate your positions, maybe shift a little bit more money to the sidelines in cash or some of those safer investments. So that's how I would play those bear market rallies, bear traps. Yep. What else? Should I buy BRK right now or wait for Buffett or Munger to die? Okay, love that. Serpa89 wants to know if you should buy BRK, Berkshire Hathaway, now or just wait for Buffett or Munger to die. I don't know where to go with that. Buffett or Munger, Charlie Munger, Warren Buffett, right? Who knows? They could outlive us all. Billions of dollars. Who knows what kind of medical service and medical products they have going through their bodies, extending life. So I wouldn't necessarily wait for Buffett or Munger to die, because that could be a very long wait. I do think once Buffett dies, then Berkshire could get hit. I think there's a lot of people out there just investing in Berkshire Hathaway because of Warren Buffett. Think he's some kind of idyllic investing god, and so that kind of weakens that theory or that theme if he dies, and who's running Berkshire after that. So I would watch out. That's obviously something you can't know when that's going to happen. So I would be worried though about that if I owned Berkshire. Whether you should buy it now. Berkshire, I think he's cut down his exposure to bank stocks, but it's typically, very bank heavy, typically very insurance heavy, typically very consumer staples heavy. So a lot of the stocks in the Berkshire Hathaway portfolio are your typical value stocks, your stocks that don't get hit quite as much in a recession or in a stock market crash. So, it's going to be a little bit more stable than, maybe some of these other funds, maybe some of these other companies. It just depends on what you want, where your exposures are. I don't own any shares of Berkshire Hathaway. I invest in individual stocks instead of a holding company like that. What else? Keith says just buy more of Coca-Cola or Aflac stock and wait. If you look at the largest holdings on Berkshire Hathaway, you got a lot of Coca-Cola, you got a lot of Aflac, Apple is another one, and basically you can just kind of recreate the portfolio by buying some of those largest holdings. That's where it's going to be. What else do we have? Stocks have dropped. It's time to get into these. So Ace says that software as a service and tech stocks have dropped a lot. Is it time to get into these unprofitable stocks? So two questions there, really. These growth stocks, the tech stocks that have come off so much. Is it time to start looking at those stocks? And the other question is, should you make a difference between the unprofitable and the profitable stocks in when you're buying? Okay, so I think there's really two different questions there. One, let's look at the profitable, unprofitable stocks. Now, obviously when tech stocks came down, when growth stocks came down, everybody was saying, "Oh, you got to buy quality," right? As if that somehow hedges their bets, right? So I'm gonna pick on Kramer because he's an easy target, smart guy, but says some weird things. He made a big shift into you have to be buying quality growth stocks, right? Over the last year, and basically that kind of hedges his bet to where he says, yeah, you can still buy growth stocks, but they have to be ones that are profitable, ones that have positive earnings, that are able to grow their profits and things like that, rather than these unprofitable companies, these companies that while they're still growing sales at 20 or 30% a year, they're not profitable yet. Now, I wouldn't necessarily say you have to avoid those stocks altogether. I mean, hell, Amazon has negative earnings for decades, okay? And look at what's happened to that stock. I mean, it went from $6 a share in 2002 to $3,000 a share last year, okay? And yeah, the thing with Amazon and thing with a lot of these growth stocks, that if you're trying to figure out, the difference between these unprofitable or these negative earnings stocks and the positive earnings stocks, is where is that money going? If they're like Amazon, if they're just spending so much in research and development, spending so much in marketing to really grow that company, then there's nothing wrong with posting negative earnings. They can post negative earnings. If they're growing sales at 20 or 30 or 40% a year, and they have a plan to continue doing that, and a market that will allow that, then hey, it could be another Amazon on your hands, right? So I wouldn't necessarily say just avoid completely like the plague these negative earnings growth stocks. Okay, you really have to look at why they're posting negative earnings. If they have the cash to survive, right? If they have the financial flexibility to keep on doing this and keep on growing their sales, eventually all they have to do is say, okay, you know what? Look, we've grown our market share to 20 or 30% of our market, of our industry. Now we're going to focus on profitability. And boom, they've got huge profits, huge earnings per share, right? Just because they've made that shift. Whereas the profitable quality companies, why are they profitable? Are they growing sales slower because they're not spending so much on their research and development or their marketing, things like that? Just because they're posting earnings doesn't mean they're a better company than some of the other growth stocks. So that's one question. Obviously, I think, as we're heading into a recession and more uncertainty, then these stocks that are posting positive earnings are going to be a little bit stronger, or a little bit more stable because they're already posting a profit. But I would say don't completely just out of hand avoid the negative earnings stocks either. The other side, should you just invest in the tech and the growth stocks and the things that have fallen so much? Again, with that market story, I think you really have to reevaluate what the market is saying about stocks and the market right now, and just don't just believe the story outright. Okay, it is a story based on a true story, based on facts, but not necessarily the facts themselves. Okay, if a company is growing at 20, 30% a year on its sales, if it is going to do that over the next 10 years, and yet the price to sales ratio has come down from 20 times last year down to 2 or 3 times this year, then I think you get back in those stocks. I think you take advantage of the crash, of the sell-off in a lot of those tech stocks, a lot of those growth names, and start picking up shares. Now, again, I think I would wait a little bit longer let the market settle a little bit more, and start picking them up then. But I do like a lot of these growth stocks for that long-term thesis. Now, understand, next couple of months, even over the next year, it's going to be tough for these growth stocks because, as the market falls and with that pressure on the market and the economy, they're not going to go anywhere, right? So you have to have that long-term focus. New York data from the New York Stock Exchange shows average holding period for a stock is now down to like less than a year. It's now down to like 5 or 6 months, right? Investors are holding stocks, expecting them to go up in just a few months, and when they don't, they get frustrated, they get disillusioned and disappointed, and they think it's a bad stock, it's a bad company, it's not doubling my money every year, right? That's not how the stock market works, folks. Sorry. It's just, yeah, it was when the Fed was pumping money or, putting $10 trillion into the economy every year. Yeah, stocks are going to boom in that, but it's fake returns. It doesn't mean anything. It's just not how the stock market works over the longer period. So you give these growth stocks time, give them 5-10 years, and they will be good investments for you. I'm going to cut it off here. I've actually got a podcast interview that I have to do here at 10:30 Eastern. So I got to get on that. And then actually I'm going to be on the Own the Chaos. I think Brad Smith's got a YouTube channel called Own the Chaos Stock Trading, something like that. He does a live stream at 3:45 Eastern. I'm going to be on that today. So you want to see more of me today, then watch for that, and we'll get into it there. But other than that, I appreciate it. Thank you again, and I'll see you in the next one.